just go straight in. So my first question for you, Doug, is how are you managing portfolio risks at ING, such as duration mismatches?
Yeah, so we mostly look at duration mismatch. We mostly look at interest rate risk on an economic basis. So we actually replicate all of our insurance liabilities with financial instruments. So we can do many calculations at one time to look at what happens in different scenarios, whether it be curve flattening, or sometimes we have two different sets of currencies, and then what happens if they move differently. So we look at all of this mostly on that basis. Therefore, we also look at the convexity. What happens if you have larger yield curve shifts, and how do those change? And interest rate risk is probably our biggest risk in the region. And the biggest problem is getting the assets you need to hedge that risk in all the markets. So in some of the markets it's not so difficult, but in some of the markets it's quite difficult. And so therefore we look at strips. We look at forward starting types of instruments, which can be very helpful where they can be created, and go with that. We try not to look just at duration, because there you get then sometimes banks pitching things like inverse floaters or some other types of strange instruments which look fine on a duration basis but don't actually make sense with your liabilities. So we try to look at the duration, convexity, and really the economic impact under different interest rate scenarios to find the right assets to help us manage our interest rate risk.
And which jurisdictions is it particularly difficult within Asia?
Well, it depends where we are. For us, it's the most difficult in Korea, but for instance, we used to have a business in Taiwan. It's very hard in Taiwan. I think in China it's not a big issue for us, but if you had a lot of long-term liabilities, I think it would be difficult to find the assets. Thailand, I think the Thailand insurers deal with these types of issues. Sometimes in Hong Kong, but there you can, a lot of the liabilities in Hong Kong are US dollars, so therefore it's richer capital markets. So it can be the case in most of the developing Asian countries, or even the almost developed countries like Korea.
Secondly, how is ALM changing against the backdrop of increased market volatility?
Well, I think the market volatility just means you really have to be very careful about that you understand what you're putting on your balance sheet. I think one of the lessons from 2008 is there were people that were putting things like CDOs on their balance sheet without understanding how the market volatility could impact those assets. So for me, I try to really keep it simple. What are we going to put on? And if I see a yield enhancement idea, or someone comes to us, I said, do we really understand where it's coming from? Are we selling options that can really move when the markets move? And we generally try to steer clear from those types of things, versus a few years ago when everyone was everything was going well. So I think the 2008 crisis, the current market volatility, reminds us very carefully reminds us that we have to be careful what goes on our balance sheet. So we keep it simple. We try to manage the key risks, and we try to make money on the underwriting side and the pricing of our products, and not necessarily try to make it all from running a hedge fund as an insurance company.
Thirdly, how are you managing the transition to risk-based capital like Solvency II? And is there still a sense that local insurers in Asia may be able to arbitrage the later time frame to implement risk-based capital in Asia?
Well, Solvency II is something that ties to very much how we want to run the business in ING. So probably going back 4, 5, 6 years, we've been trying to manage our ALM, look at our pricing of our products on a Solvency II basis. So for us, it's a little bit natural that transition to making it real, and actually creates a more level playing field throughout at least European insurers operating around the world. It has, and it still will continue to create an unlevel playing field in some of our markets where companies do not understand the value of the options and guarantees that they're selling. They may be taking asset risk for which they really aren't holding any capital for, because they are arbitraging their local RBC formula in some way, and that's just something that we'll have to live with. I mean, I think it is a long business. There'll be times when you'll have difficulty because of trying to manage on more of an economic basis and on a Solvency II basis, but there are times where you'll make better decisions. and I believe those will come home to be beneficial from over time as well. So it's not hard to compete in Asia on the Solvency II basis. There's a lot of health and life insurance products are sold here. Those look very good under Solvency II basis. It's only in some of the markets where these savings products become very challenging from a value standpoint. But that's okay as well, because in the end you manage a whole business and you try to find the best way to compete and to give a return to this policyholder and the shareholder.
Okay. The IIF recently said there are inconsistencies between Basel III and Solvency II. So that, for example, a 1-year BB rated bond held by an insurer attracts only a quarter of the capital backing than it would if it were held by a bank. But a 10-year BB bond is 1/5 more expensive, which incentivizes insurers to hold shorter term debt when their liabilities are longer term. Do you believe this may pose problems for insurers in the region?
Well, one of the things that, about Solvency II is certainly that the longer term credits attract a much higher capital charge than we've ever seen in the industry. And that is, I think, because of the credit spread widening that's now involved in all these models, which has not normally been involved in a model. It will, where possible, certainly in Europe, encourage short-term credit and long-term swaps to hedge the risk. But I think in Asia, there's not a lot of long-term corporate bonds, but there are. You have to use government bonds to get long-term interest rate risk mitigation. So I think for us, for most insurance companies, it's still more important to mitigate the interest rate risk, because if you go in Asia, at least, if you go to short-term credits and leave open the interest rate risk, you will have, without the ability to invest in swaps, then you'll probably end up having more capital, because the interest rate risk capital will be higher. So I think there is certainly something to long-term credits. Insurance companies will have a much tougher time investing in than they have in the past.
Finally, is the use of liquidity swaps gaining popularity in Asia, especially against the backdrop of the Basel framework, where banks are having to increase the number of liquid assets on their balance sheets?
Yeah, I think it's becoming increasingly reasonable to me that the insurance companies should try to find yield from using the illiquidity of their liabilities, along with if they have excess liquidity on their liability side. And it's certainly from Basel changes, the banks have become much more hungry for liquid assets. And so there is a natural market developing to give up some of the liquid assets that insurance companies hold, which may be used to manage interest rate risk or something else, to the banks through some sort of term lending or repo or other types of transaction, where it may create a win-win for everyone. Therefore, though, you get into I'm in a lot more discussions about what collateral is okay for a term lending transaction or something like that, and therefore we have to make some additional types of risk decisions which we haven't made before. But I do think there's a natural market there that can be beneficial to both firms.
And our regulators, do they have a view within the region about this practice and whether there's potential risks, or
I don't think the regulators in this region are are paying that much attention to this. I think one of the things that we as risk managers have to do is to make sure before we start passing out liquidity that we have enough liquidity. So one of the things our firm is doing is really enhancing our liquidity risk management, because if you want to take advantage of these opportunities, which I think is very much a good thing to do, you want to make sure that you have the right liquidity in place, and for stressed events as well, because you don't want to get in these types of arrangements and then run into liquidity problems yourself. But I believe there is a nice sweet spot there that can work quite well, and I think regulators if they see it, they might get a little bit nervous. But I think if they understand it, and if we do it in a professional way, then there shouldn't be much difficulty.
Okay. I think that's it. Okay. Thanks very much.
Okay.